All right.
Okay, so we are now live, and we'll give it a few minutes here for folks to join.
Mhm.
And recording and transcription is enabled, so we can certainly add that on here as well. We do have a YouTube channel. We don't use it very much, but I can upload this recording to our YouTube channel as well.
Great, very cool.
We've got like 2 or 3 videos on there right now, so we'll see how that goes. For everybody that joins, I do have their mic disabled, but everyone should have the hand raise icon in Teams, so we should be good there. Doo-doo. Okay. So we will give it a few minutes here, since we're now at the top of the hour, and most people, like myself, like to join in a minute or two late, just to be fashionably late.
Yeah. They have back-to-back meetings, right?
That is, yeah, especially during the holiday season and how things occur there.
Mhm.
Get some adjustments here. All right, that feels better. Ah. Just checking one thing here. Okay, so Q&A has also been enabled for this event. So people, if they don't want to ask a question live, they can ask it in the Q&A.
Mhm. Right. And anyway, we can still record the session and post it, right?
Well, the recording is live now, so it is
Okay,
being
good.
recorded now. So we will absolutely post it in the session. All right. So, wait another minute, or should we get started?
Yeah.
Yes, wait another minute, or yes, get started.
Yes, let's wait another. I'm sorry. Yeah, let's wait another minute and then we just start. Get the thing recorded, and people can just jump on the train.
Sure thing. Okay, it is now 3 minutes after the hour, so let's go ahead and get started. If we don't have a lot of Q&A at the end, that means we have a little bit more time to talk about the things that are near and dear to us. And I have some questions prepared for you, Klaus, if we get to the Q&A. And
oh, great.
Nobody has any questions, so I'll tee up a couple of things.
Hey, fantastic. Good.
Okay, so let's go ahead and get started. Welcome, everyone. Welcome to Financing AI Innovation. This is about applying real options to increase AI project success rates. So I'll talk about what that means in a moment. This was gathered from research. I did a research paper recently. It's actually a working paper. It's called the AI Pilot Paradox. You can find that on my LinkedIn profile. The LinkedIn profile actually has the article, which is more of a summary of the academic paper because nobody wants to read 25, 30 pages of academic prose. So, or whatever it was that however many pages I did. So the article is a much friendlier read. If you're having trouble sleeping, then go back to my regular paper and that'll take care of that. So let's talk about increasing success rates. My name is Joe Vallone. I am a professor at Georgetown University. I'm also a doctoral candidate at Purdue University. And specifically, I am working on AI governance and strategy. I also have a background in finance and economics, which dovetails nicely into what we're going to talk about today. And in my normal day job, I am the Chief AI Officer of Outcomes 360. Klaus, why don't you introduce yourself?
Thank you, Joe. Hello, everybody. My name is Klaus Holzmann. I'm engineer at MBA, and I've got extensive professional experience in R&D, innovation, strategy, and finance. And it's exactly at this intersection of these topics where I'm passionate about modern real options. So that's a topic we can share today. And I have co-founded a company called Strategic Finance that provides modern real options indeed.
All
Joe, over to
right,
you.
thank you. Thank you, Klaus. So let's get to the meat of this. Why do AI pilots fail? And are they failing at this rate? You may have seen the headlines, some I might even argue clickbait headlines that talk about failures. There's various studies out there. There's the Rand Corporation, which talked about, I think it was 80% or 85% of failure. The MIT study that's claimed 95% of AI pilots fail. And there's a Gartner one, I think, that talks around 60%, something like that. So why are they all over the map as far as that goes? Well, there's a couple of things here. So first of all, um, you have to define what success and failure means. And pilots or MVPs, there are different financial, cultural, and I would say leadership challenges around those things because AI is new. The definitions of success and failure are wide ranging. So what I did in my research paper is I dug into that data. And it turns out the data really lacks any kind of academic rigor. It doesn't comply with the central limit theorem. The data sets are not public. They're not random enough, and they're not truly random, I should say. And they lack a lot of the type of data and governance structure that we would see in academics around those types of things. So the bottom line there is it's not 60%, it's not 80%, it's not 95%. And we don't really know exactly what that number is because, as I said, the definition differs. But what we can do is there are some common themes that came out of even the Rand report and the MIT report. And as you can see in the bottom of the slide, there's a new one from Duke Corporate Education. They did a study as well. I posted about this yesterday, and that one sort of confirms what my study said, and also augments it in some areas. And there are certain common threads that we can see there. First is rigid funding, trying to use old ways of figuring out what the value is, a lack of governance, and certainly the classic failure to ignore sunk costs when you're doing this kind of thing. And that prevents us really from pivoting when we're working on these pilots to something more valuable. And a lot of that is we just don't have the transparency to do that. And when we're talking about increasing success rates, as we'll see, we need that kind of transparency. I want to be clear. It's not the fact that they're saying there are AI pilots that fail. There should be some failure. If you're not getting any failure, you're not pressing hard enough. I don't know what that number is. Maybe I could opine that maybe it's 30%, 40%, 30% plus or minus 10%, something. But your failure rate shouldn't be zero. If it's zero, you're not risking anything really, and that happens because people are too risk averse. I also want to be really clear that these aren't technical failure. The technology is there. The generative AI that we're seeing today works really well, and you can see it in the markets. There are failures in financial design and organizational integration, and even business process and business models that are not adapting quickly enough for this. So, what do we need to do? We need to fund innovation, but we need to do it with discipline, and we need to do it with adaptability and agility. And so, what is the answer to be able to do that? Well, surprise, surprise, it's not net present value. It's modern real options. Okay. We use the word modern real options because it's also not the classical real options that were invented in the 1980s. Um, it's Klaus has some IP on this that doesn't use the classical Monte Carlo simulations. And what we'll see is that there's actually much greater transparency and much better ways of determining the clarity of value. And that's what we want to talk about. We do need to get clarity on value, as I alluded to in the previous slide. We need to define what that is, and we need to ensure that the fundamentals are there. They got to be realistic for value potential, and that's where the guardrails come in. So we need to ensure that the project fundamentals are there. There needs to be a clear business problem that needs to be solved. We need to define what the success criteria is for that. And we do need to get the buy-in from our leadership, from our business, to make sure that we're going to continue to add value, not only internally but externally to our customers as well. We need to have good infrastructure there, and we know that there are going to be some changes dealing with this. So change management, change leadership is also a part of this. And then finally, we also need to make sure we're ready for this. We need to make sure we have good infrastructure. We've done investments there, and that our data is ready. It's clean. It's ready to be used. Otherwise, garbage in, garbage out. So if you don't have a good data strategy, if your data is not ready to be used with AI, you're going to get unpredictable results, and that's not good for anyone. Klaus, over to you.
Thank you, Joe. So absolutely, your point is well taken, Joe. We need to make sure that the fundamentals are there for a realistic value potential to ensure realistic value potential of our AI initiative. So this makes sure that the value is at reach. We can enhance our chances of success. But then we also need to filter. We need to make sure that even if we have enhanced our chances, that still the overall initiative will be value creating. And this is where we need to create a business case. And to build a realistic business case, we actually can no longer use net present value, as you pointed out, Joe. We need to use real options, but we need to use real options in a way that is really applicable, that is transparent, where we can express our business assumptions in an intelligible way, such that we can first all together, all stakeholders can agree on them, and then we can do the calculations and draw conclusions from this. And this is where modern real options come into the game. So modern real options start with the clarity about value by asking, first of all, what is the ideal financial outcome? So we're telling what is our objective, right? This is our driver. This is why we dream about this innovation initiative. We have to be clear about this. Are we talking about a 5 million, 10 million, 15 million dollar opportunity? What is it what we're talking about? And then we also recognize that this is, of course, new. It has never been done. It's uncertain. We are not sure about reaching this ideal outcome. But we can tell what uncertainties have to be resolved positively such that we reach this ideal outcome. And this defines the steps we need to take. So if we take actually and we progress with agility, agility means with a stepwise progress. And each progress will teach us something. We derive learning from that. And this learning will then inform what is the best next step to take. We adapt, we are agile. And this can be perfectly represented throughout modern real options. So what that means is that thanks to this kind of agile progress and learning approach, we can decrease financial risk, we add value, and thanks to modern real options, we can then govern by financial value. And governing by financial value occurs on two levels. First, on the individual project level, the business case level, where we can determine whether we shall accept the project or not. And not only we can determine whether we shall accept or not, but before doing that, we can actually even enhance the value creation, because we are talking about steps that need to be taken. And you may remember there are some strategies like formerly called fail fast that we like to rather coin as learn fast. Or fail cheap, higher risk for higher return. So basically what this means is we can have strategies that increase value by rearranging our stepwise approach. And then at portfolio prioritization level, we can also use these financial capabilities to calculate the cost of delay and value, WSGF metrics, such that we can allocate resources in the most value-creating way. So we've got here a financial disciplined way of allocating resources in the most value-creating way. Here's an example. Of a typical AI, or simple, actually, a simple AI project. So to begin with, we start with telling our dream. On the right-hand top border, you see, be clear about the value. So we're telling what we're talking about if everything goes well. And on this basis, we define what uncertainties have to be investigated stepwise, as shown here on the blue steps. And if all those uncertainties resolve positively, we shall reach that optimistic, that ideal outcome, that dream outcome. And this also allows us then to tell our agile project story. And you see it here outlined, right? The first blue brick tells us, well, make sure that the fundamentals are there as outlined by Joe as per the results of his research paper. And if these fundamentals are there, if we are pass, we can move on. Otherwise, if that fails, we have already screened this project. But if it passes, then we can proceed with the actual development, exploration, validation, pilot, scale up, all these various stages, and also in parallel to pilot as per the recommendation of Joe's research paper, we can also ensure that the infrastructure is prepared for. And this then actually completes our simple agile project story. So you see that modern real options allow to express in a very natural way our agile project story. And then in the next step, we add to that story the financials. So we add here the investments that are shown here as red figures above each blue brick. We've got a notion of time, as you see on the timeline on the top of that figure. And we have also probabilities for the various results, in this case, just pass or fail results, but it can be any number of results. And also we already clarified what is the ROI in our best case. But we can also, in more complex cases, cover various other scenarios for ROIs. So with this financial data added, we have now expressed all assumptions for that are necessary for a real options valuation. So you can see that this is really intelligible, and this is particular to modern real options. We express assumptions in a very intelligible way. And so we can indeed discuss around about these assumptions and converge with all stakeholders before proceeding with the actual valuation. So let's presume that we have converged, so we can now proceed with the actual valuation. Here it is. On each brick, you see a label with black figures. These are the net option values, the net value of the project. And so you can state that we can actually tell for each project step how the value evolves, right? So that's already a remarkable property, and that corresponds to our intuition that as we progress and as we resolve uncertainties positively, yeah, the project value should increase, which it actually does, and we can see this from model real options valuation. Let me also elaborate on what these net values actually mean, because it represents the investment rationale. The investment rationale is that if you just look at the very first step, the very leftmost step, here we are meant to invest 50. If we want to launch the project, we invest 50 in the first step and just in the first step. And if we invest in the first step, the logic is that as soon as we have invested in the first step, we are receiving the opportunity or option on the remainder of the project. So the step investment has an immediately recognizable return. It's the option on the remainder. And the value of the option on the remainder is calculated. The value is not shown here, but the value is 60.8, shown on the left-hand side, not shown in the graph, minus the investment of 50 into that step, provides us with a net value of 10.8K, the value that is labeled on the first step. So what this means is that it's worthwhile to do the investment in the very next step. It does not tell anything about the other investments. We will see later, depending on what we will have learned from the previous step. Right, and we can contrast this with the net present value calculation that we can also perform for this tree structure here. The result is minus 48.5, so it's negative. So what this suggests is don't invest, but if you want to be clear, more precise, what the NPV is asking is a question about, do we want to invest all or nothing? Well, investing all into such an uncertain project is risky. And no surprise, if we perform the calculation, we get a negative result that tells us, well, if we're asked to invest all or nothing, then don't invest at all. And that's important to realize, because NPV is not asking the appropriate question. Not appropriate because it's investing all or nothing is just not what we are asking for. We are taking a stepwise approach. So all we are asking for is, shall we invest in the next step? And real options can answer exactly that. So the implication is that by asking the right question, we're getting a right answer, and we're able to seize innovation opportunities that we would have missed if we had used the NPV. Over to you, Joe.
Okay, thank you, Klaus. And I'll opine just a little bit around net present value. It was invented in 1908. Nobel Prize was received, so it's been known since then as the gold standard. And I'm not sure how many of you were alive in 1908. Probably no one. I'm also not sure how many of you knew what computers and internet were in 1908. There wasn't any. So it was designed for a different time. It was designed for homogeneous systems in that era, manufacturing, because it was all about manufacturing. So there's a lot of things that have changed since 1908. It's been a minute. And the problem with it is that it requires that you have some knowledge of the variability, the risks involved, so that you can quantify them with the discount rate or hurdle rate, risk premium, whatever you want to call it. And you can do that in a manufacturing scenario, because you know the number of widgets that have come off the assembly line. You know over time how many of those widgets are defective, the variability aspect, and you can quantify that. You have the historical knowledge, and so you know we're going to have 5% defect rate or whatever the case is. that was designed for a different time. That doesn't happen today. We have a lot of uncertainty, especially when it comes to artificial intelligence. We cannot use net present value. Well, I shouldn't say that. You can use net present value to evaluate these things, but you are most likely going to be wrong. You're either going to underestimate or overestimate the risk premium, and that's not where we want to be. It doesn't provide us transparency, it provides us a lot of guesswork. So, what's the answer? The answers are modern real options and pair that with lean portfolio management. So, real options aligns perfectly for this. As my old mentor Don Reinertson used to say, we're no longer incentivized to follow a recipe like we are for homogeneous systems, i.e., manufacturing. Um, what we're incentivized to do now is not follow a recipe, but innovation. And that's what we're trying to get to. But the question becomes, how do you measure the success of innovation? And so real options aligns with this. It is a pretty powerful framework for innovation, especially at scale. You could see from Klaus's diagram how it scales over time. We are purchasing an option. We're not obligated to execute the next step. If the data is telling us, if the financial data, the value that we've defined, if it's telling us we're not going to be successful, we can exit. And we can do that and reduce the sunk costs. It's very hard to continue with sunk costs if the data is staring you in the face and it's saying, hey, you are not going to get the value out of this that you thought you were. You can continue, but you do so with the knowledge that you're going to lose money. We need guardrails around this for exploration, and real options is great for that because, as I said, the transparency. So it can help us define the acceptable risk levels, the investment thresholds, how much we want to invest, how much we want to continue to invest, and it gives us options in decision making. And that clarity, that financial transparency, really helps us with our strategy as well in obtaining our objectives. We want to use data, actual facts, and not just forecasts or gut feel or intuition, because we know that's going to be wrong over time. And we don't want to use outdated, more traditional financial metrics. We want to use something that adapts to agility, that is incremental, and provides us visibility into the value obtained over time and at scale as well. Klaus, over to you.
Great, thank you, Joe. And absolutely, this is exactly the point. If I summarize the advantage that you just mentioned for AI portfolios, when we use real options, really stretches along three pillars. The first is strategy, then finance, and cultural. So for strategy, we already discussed, right? Thanks to real options, we can seize opportunities that we would have missed if we had used NPV, but just by asking the right question and by representing the reality of our project approach. Also, we can accelerate our time to market through fast decision making because business casing with real options is fast. The real options allow us to tell the narrative of our agile story, and there is no guesswork about what will be in the future. We just tell what could happen in the future. So this is fast. Business casing is fast, and then at portfolio level, the actual resource allocation is fast as well. So we do not lose precious time with lengthy discussions about business cases. And then we boost innovation because uh, as of now, we are able to justify the value creation of innovation as of day one, as we had seen in the case example. From a financial perspective, we reduce waste and sunk cost because we adapt investments, right, as we move on. So no useless investments. And we had also seen that we can maximize the value of our adaptive projects, of our agile projects, by adjusting the sequence, and we can also maximize value creation at portfolio level throughout financial portfolio optimization. This is an important feature that is otherwise hard to implement, and now all of a sudden it becomes easy, fast, and rational. And also, thanks to the fact that we can justify the value of innovation expenses, all of a sudden we are able to capitalize them, which means that we can relieve pressure on the P&L. And from a cultural perspective, well, we encourage experimentation and learning. So this means that if we stop a project, this is no longer a sign of failure. This is a sign of learning. Very different. And then we avoid overcommitment of people, right? They commit to is that they execute with high fidelity the tree structure that we've been showing right from the beginning to our sponsors, but we cannot at all commit to the actual result that we will reach. This is part of the agile navigation we will go through. And then we focus on outcomes, not outputs, simply because we dispose of a business case. We dispose of an agile business case, and the business case makes the link between efforts and outcomes. So all of a sudden, it's more than just delivering something. We can measure the value of outcomes. And also, we build shared understanding across teams because real options actually are nicely in line with our operational way of approaching project in an agile manner. So we actually bridge the worlds of finance and R&D. Over to you, Joe.
Okay, so how do we begin? Where do we start? What's the first step? So the first step is really around identifying your AI portfolio. So we got to get a handle on that. What AI initiatives are in there? We can group them by strategy, risk profile, stage of development. And by the way, the real options thinking, the real options model itself works fine. You don't have to start from the very, very beginning. If you have things that are in flight, we can still use this. And really what we're trying to do here is gain transparency into your entire AI landscape, what things are going to be pilots, et cetera. We have to also define the decision thresholds. So what's acceptable risk? And as you saw on Klaus's diagrams, we do have those probabilities which are aligned with the success rates. We have to figure out, what that information is. We have to basically define. We're purchasing an option on whether to take the next step or not the obligation. We don't have to advance to the next step. But how would you be able to decide whether you're going to advance to the next increment or not if you don't understand what that value is? The modern real options approach allows us to see that. It allows that transparency. With that, it allows you to have better guardrails in. You can define, well, is this within our acceptable range or not? Do we need to pivot to something else? Do we need to declare this a sunk cost and move on to something that's even more valuable? So those things become really clear when you're able to see all of the value that is being created. We can use leading indicators to help measure that rather than a lagging indicator such as net present value, where you really don't find out till the very end whether you've gotten some profitability out of that or not. And then we also need to make sure, which is built into real options, by the way, that we're funding staged experimentation. Each increment we are funding. And we can do that because, again, it's transparent. As you saw in Klaus's diagram, we can see those numbers and decide whether we want to move, whether we want to purchase that option to the next stage or not. What's the bottom line? What's the summary? There's some key takeaways here. And so how do we really increase our success rates? Well, we do that through a number of ways. We know that the traditional way to fund the pilots is not successful. It's difficult. It wasn't designed for that. And so this doesn't aid our strategy. It doesn't aid our portfolio, and it doesn't contribute to learning and value creation. I'm not a big fan of the term fail fast. I am a big fan of learn fast and fail cheap. So the shift from pilots to actually being able to evaluate the pilots for the value they're producing and whether we want to scale them and whether we want these pilots to actually mature and ultimately be successful in our organization, we need a financial metric to be able to do that, a framework, if you will, and Real Options does that beautifully. And it's a new approach to how we do AI innovation. Once you have the transparency, you can make those decisions and you can start making those decisions with even the small AI pilots that you're doing. And once you have that, you can see where it's going, you can see how much you're going to make on it, and whether you want to continue or not. That increases your ability to succeed with AI pilots. And as I said, it's AI doesn't fail. The technology is good. It's great. In fact, generative AI is awesome, and you can see it in the market. It's doing real things. So the funding models and the organization, those are the things that fail if we're using the traditional methods. Real Options changes that. So what to do? Take the next step. You can read the article. I've got it in the chat. I can send it to you, whatever you need to do. I also have the Duke paper available as well. And you can even schedule a 30-minute discovery session with myself and Klaus. We'd be happy to give you a quick demonstration of the tool. You saw the output of the tool, but you didn't really see how it works. This is more of an informational session. And with that, I'd like to move on to the paid advertisement section, since this is a free webinar. We do have some AI courses that are coming up. These won't be dedicated to Real Options, although we may talk about it. These are dedicated to AI native courses to learn AI and to advance as a change agent. And so we have some upcoming courses there. The link to register for these is also in the chat. And we can send these along to you, or you can just go to the website that's up top. So thank you very much for your participation. And now let's talk a little bit about the Q&A. We have a few minutes left. Klaus, are you able to take a few questions?
Yeah, sure, with pleasure.
Okay, let me start off with the diagrams that you showed us, which is the output from the tool. And we did this for the webinar. We intentionally made it simplistic, but talk a little bit about the fact that most projects aren't that simplistic, right? You may have options on options, so to speak.
Yeah.
You can have many different branches at each stage. Is that correct?
Absolutely, absolutely. So yeah, what we had shown was a very simple project pathway, right? Just pass, fail, pass, fail, pass, fail, right? And in general, you won't, right? And it really depends on how you design your project. What is your agile project story? For example, in your research paper, you had mentioned that at some stage, it may also be advisable to call for AI specialists. So you may do so once you have completed the first explore step. So your agile story may then continue. In case of failure, you may not just stop, but you may call in for an expert and then again explore and see whether you can take it from there. And then you can also cover all other aspects like go-to-market aspects. What about marketing and sales? How is the actual success? How will you push for even more greater audience? Will that pass or fail? So it's all about market penetration aspects, and that will lead you to various or internal usage rates, right? So this will all result in various possible returns on investment, sorry, returns on investment. And you can express all these aspects. So you're fully free to express this, right? And that's what's particular to modern real options, right? Um, it's really about how you approach the situation, what strategies you are taking, and you can represent them. You can even, you mentioned options on option. You can even tell that, hey, I'm doing here something that not only has an immediate effect, but also opens me doors to other applications.
Right.
And this is what you typically have when you introduce new technologies, right? In many circumstances, CTOs ask, okay, I've got a new technology, but it may not have a direct use, a commercial use case, but it enables commercial use cases. So you can represent this, right? Your technology development is then an option on the value of commercial use cases. So you can still express your realities, right? And you can justify technology development in the first place, and so on. So you can actually capture all aspects of what you as innovator believe is valuable in your idea.
And that allows us to, really quantify the value of agility, even, right?
Yeah, yeah. Oh, good point. Good point. It turns out that this calculation allows you to represent agility or adaptability. Having said that, we can also neutralize that representation in that very same calculation. And what you then find is the net present value. So what this tells us are two things. First is that real options are a generalization of net present value. Net present value is a special case of real options. But beware, this does not mean that you can use net, discounting techniques as used in net present value to
Sure.
actually evaluate real options. That's a different technique. Those are replication techniques. But it turns out that yeah, real options is a more generic point. So if you then compare an evaluation with the representation of agility and a representation without agility, the difference in value is actually the value of agility itself. And it
Mhm.
turns out, and this value just comes from, or mostly comes from adaptive investments, like I stop or I continue, I increase investments, I decrease investments, I adapt them, right? And this adaptability creates lots of value and also decreases risks. So these are the two ingredients that actually are the drivers for the value of agility itself. And it turns out that, as we have seen in our case example, typically, if not always, innovation projects have a negative NPV. Uh, so it's actually the value of agility that makes a difference. It makes the project viable, at least when it comes to asking, shall I undertake the next step? It's a more important difference. And yeah, so the value of agility can be quantified and it's substantial. It can make a difference.
So, in the last 3 minutes, the final question is: what are the advantages of using a dedicated tool like what you have for calculating these real options on um, innovation and AI pilots versus, let's say, someone trying to do this with just traditional Excel?
All right. Well, okay. If you compare this to traditional Excel, well, first of all, the usual suspects here are, of course, that Excel is nice. It can do everything, but it's not robust. It's very error prone. It's slow. There's no automation, so it requires some specialist, some expensive specialist to work on all these representations, right? As opposed
Yeah,
to a
because you're going
tool
to
that
craft an entire financial model out of that, right?
yeah, you can. But if you've got all this expertise encapsulated in a dedicated software, you actually will benefit from robustness and speed, right? And that's important because I mentioned earlier that we like to at project level to find out what's the best design according to strategies like learn fast, fail cheap, higher risk for higher return, etc., etc. So you may want to try out various project designs, in terms of how the various steps are sequenced or put in parallel, right? So if you want to try that out, you cannot do that under Excel. It's impossible, right? It's too
Right.
complex. It's time consuming, but you can be sure to make mistakes. Not to forget about other features like when it comes to the calculation of WSJF, you want to know about cost of delay, and the cost of delay itself has is has an considers how that is will the expected value creation of our project decrease if it's delayed because we give priority of funding to some other project, right? And here again, you need to do calculations that are pretty complex, and under Excel, you won't just be able to do that. You need to also to capture here not only the delay of the effect from time value of money, but also the effect of decreased return cash flows from delay. So if you want to do that manually, you can give it a try, but actually this is a nightmare. And even for simple topologies, as we had seen in this case example, but real projects have all freedom and all complexities. So clearly, you need a tool for this, and same is then true for the portfolio prioritization. By the way, portfolio prioritization is very value creating. If you do that financially and in the right way, you create enormous value compared to having just no clarity about which project to prioritize. So just the little efforts to put real options in place is nothing compared to the financial benefit from financial portfolio prioritization. The
Right.
payback is immediate. Just do it right once, and all small efforts you had to do are paid back immediately.
Awesome. Well, thanks, Klaus, and thank all of you for joining, or if you're watching this in the recording, appreciate your time. Please let us know, reach out if you have any questions about this, or if we can help you with something in the future. So have a good day. Thank you very much, everyone.
Great prayer. Thank you very much. Goodbye.